Hello and welcome back to another video. My name's Sam and today we're going to talk about a crucial aspect of investing: managing risk. Investing always carries some level of risk, but with the right strategies you can minimize potential losses and protect your hard-earned money. Before we dive in, feel free to comment down below with any questions or interesting insights and make sure you stick around so you don't miss out on anything important. Alright, let's go. The first step in managing risk is diversification. This means spreading your investments across different asset classes such as stocks, bonds, real estate, and commodities. By diversifying, you reduce the impact of any single investment on your overall portfolio. If one investment performs poorly, others may compensate for the loss, reducing your overall risk. Diversification can also be achieved by investing in different geographic regions. Economic conditions, political factors, and market cycles vary across countries and regions. By spreading investments globally, you can potentially reduce the impact of any single region's economic downturn on your portfolio. Another aspect of diversification is investing in different industry sectors. Industries can go through cycles of growth and decline, and by having exposure to various sectors, you can reduce the risk of being heavily impacted by a downturn in a specific industry. Now, let's talk about the importance of conducting thorough research before investing. The more you know and understand your investment, the less you're exposed to unknown risks. This is why it's crucial to stay informed about the companies or assets you're considering. Analyze their financials such as balance sheets and income statements. Understand their business models like growth prospects and revenue streams, and stay updated on industry trends. This knowledge will help you make more informed investment decisions and reduce the risk of investing in poorly performing assets. Next up, let's talk about concentration. When you concentrate on only one trade, it can be much riskier than diversifying across multiple trades. Suppose you risk your entire portfolio on just one investment. If the value of that investment goes down by half, you would have lost 50% of your portfolio's total worth. On the other hand, if you only allocate a small percentage, such as 5% of your portfolio, to that one investment, losing half of it would only put your portfolio down by 2.5%. This loss becomes more manageable and easier to recover from. Generally, many investors choose to limit the risk they take on each trade to no more than 2 to 5% of their account. By following this risk management strategy, you can protect yourself from the potential negative consequences of over-concentration in a single investment. Risk management also involves setting stop-loss orders. A stop-loss order is a predetermined price tool at which you'll sell an investment if it reaches a certain level. This helps limit potential losses by automatically triggering a sale when the investment's value declines beyond a specific point. Stop-loss orders are particularly useful in volatile markets or when trading highly volatile assets. They allow you to define your risk tolerance and establish a predetermined exit point if the investment doesn't perform as expected. This way you can avoid emotional decision-making during times of market turbulence, where panic selling or holding on to a declining investment can lead to a greater loss. When setting a stop-loss order, it is important to consider your risk appetite, investment strategy, and the specific characteristics of the asset you are trading. The stop-loss price should be chosen based on careful analysis of the investment's historical price movements, support and resistance levels, and overall market conditions. Let's move on to our final aspect of risk, which is an emergency fund. An emergency fund is a reserve of cash or liquid assets that is easily accessible in case of unexpected financial needs or market volatility. While investments carry various levels of risk, no investment is entirely risk-free, and the market can be unpredictable. Having an emergency fund provides a safety net, allowing you to navigate temporary downturns without being forced to sell your investments at a loss. By having a cash reserve, you have the flexibility to withstand market fluctuations and avoid making impulsive decisions driven by short-term market movements. This ensures that you can stick to your long-term investment strategy and avoid making hasty, emotionally driven choices that may harm your overall financial goals. The size of your emergency fund will depend on your individual circumstances, such as your expenses, income stability, and risk tolerance. It's generally recommended to have 3 to 6 months worth of living expenses set aside in an easily accessible and low-risk account, such as a savings account or money market fund. Well, that's it for today's video on managing risk in your investments. Remember, managing risk is an ongoing process. Diversify and regularly monitor your investments. Stay informed about market trends and adapt your strategies as needed. Don't forget to like this video and subscribe to our channel. And since you've reached this far, here are 2 more videos that you might like. I'll see you next time.